Our next speaker is from ITI Mutual Fund. He is Mr. JP Singh. He is no stranger to IFPA and Chennai. So he has come all the way to attend our session. So he has over 3 decades of experience and is a chartered accountant. Now he is the head of sales in ITI. CEO, sorry Udit. So CEO from ITI, please welcome you to the stage, sir.
Many of you, and very frankly, let me apologize. I may not remember all the names when I meet, right? So there is one thing you all remember which I have forgotten, and you all say that one of the presentations which I made here, and same room I made, was you remember the most is a presentation called Abhi Tiger Zinda Hai. Right? So that we made it about a year back or so. So before, I have 2 objectives. I have some time I got. I thought, what should I talk to you about, right? So let me start by asking you a question. How's your mood? How's your Josh? So if you heard about that movie, so how's your Josh? So, hi? Right? How's your mood? Right? So, if in 5 minutes first, if I want which major of this presentation I'm going to cover tomorrow, so if I can just tell you, be prepared for the biggest challenge of your life. What happens in the market is everything is recency biased. Right? Last 5 years back, how many of you remember that we went through a challenge which was called COVID? And we are one of the lucky countries where there was a visionary who was executing something which led to a digital India. This person is called Nandan Nilekani, right? Supported by the government of India. So I tell stories. So today, because time is short, I will not go into details into this. This project was not supposed to take off. Against those challenges, this project got made. 2020, when COVID hit, we were homebound. The digital India is what helped us. The biggest benefit for mutual fund financial services was that KYC went online. The scale went up, we acquired more business, we acquired more customers. So the challenge which I feel you are going to face, the Josh is high. Keep it high, because that Josh is required for the next 1.5 years. We will go through a cycle because of multiple factors which is coming mainly outside India, mainly coming from USA, right? So a simple thing, a simple conversation that Trump is coming to power may come to power. And now Trump has come to power. He has taken the oath. And that is what is leading to disruption. Simple things. We are we are taught simple conversation like interest rate goes down, yields come down, which means cost of borrowing comes down. What has happened in USA in the last 3 interest rate cuts? Interest rate went down 75 basis points. The yields went up almost 1%. The USA, whose currency was depreciating, appreciated against everyone. And the problem is this, that world financial positions, world financial investments are based on future outlook. The future outlook was simply against this. And that is why all positions are being disrupted. So in India, there are some short-term challenges that we are facing. We are hearing GDP coming down. It is all short-term, I believe. But why I'm telling you that Josh needs to be good, because next 1 year, what is going to happen? And let me first give you perspective. I believe that in the capital markets, there are 3 things that we have to watch for. There are 2, but I'm breaking down to 3. First, it is the macro. Macro is how GDP is, how global growth is. It is India's GDP is good, one of the best in the world, but as against what we were growing, it is little less. First thing. Second challenge, the earnings, which is when we talk about stock market, we talk about equity markets, we talk about positions. In simple terms, we call earnings, and how valuations are vis-a-vis earnings. Because earnings fell, valuation became expensive. 3-4 months back, all of us thought that FI is selling India because Trump, in expectation of that, but in hindsight, maybe by luck they are right, because markets came down due to their selling and due to earnings expectation getting downgraded. The problem is this, when 14% was expected, only 5-6% is left for the year. So against 14% expectation, 5, 6, 7% will be delivered. So automatically the markets will have to rediscount themselves. And the third problem, the third position is this: all the financial positions in the market. Remember, there's too much of money which has gone into every product in the world. Commodities, gold, oil, equities, debt, currency. So there is money which is put on a bet on the outlook. And these positions, if they get disrupted, automatically for some time, irrationality comes in. Right? In the last 1-2 months, there are stocks which were multipliers and are down 30, 40, 50%. You know what has happened? 100 became 300, 300 become 100. So 100 becomes 300, 200%, mathematically even 50% comes down, everybody's out of money. And this is where more selling comes in. Right? There's a Hindi saying, mandi mein mandi, teji mein teji, which is when the markets are bullish, everybody says are positive, they'll take out money from FDs, they'll take more leverage positions. When the markets are negative, everybody cuts position. Why I'm telling you to be ready is you are most required in the coming times, because investors' journey of financial growth, of wealth creation, is emotionally attached to the goals which you have to remind them. Now, it's so easy for everyone to say market is high, let it correct, I'll invest. But when the correction happens, they think even if they have money, they'll not disclose to you. Or they will suddenly remember that let me take out the money. So this is why I'm saying, I think, let me be wrong. If I am wrong, nothing has gone wrong. Because the business is as usual. But I believe that we are in a cycle where price corrections have happened and more or less over. There's some price correction left. And this is where you will be most required when the frustration comes in, which in technical terms are known as consolidation or time correction. Right? In some time, in few months, you will go through a situation where even if your NAVs don't fall, your 1 year returns will look like minus 10%, minus 12%, minus 8% in few months. Why? Because 1 year back, 6 months from here, 1 year back, market was 26,000 Nifty. Even if it doesn't fall from here, then your outlooks will look like, all the returns will look like 10, 12%. And I'm telling you, you don't have to remind anybody. CNBC will remind everybody. Some television will remind everybody. Somebody on the media will remind everybody that this is happening. So be prepared, because my belief is a prepared mind will be better positioned to take care of the challenge and take care of the investor. Right? So what I'll do, I am stopping at this is what I told you is a summary, because time is short, so I have to just rebuild those things. But I'll take help of Ranjan so that, if we can run some vested interest from our side, if I can just run, right? So many times I have talked about many things, but we are launching a product. The product is very simple, but I was surprised by the product concept myself. But till I did not go into the product, I did not know details. But details goes like this, that 22 years back, when I was in the distribution, right? So I sold a product which was known as FMCG. So XYZ AMC will launch a product, and it is named XYZ AMC, so it is XYZ FMCG product. What has happened is last 20 years, things have changed so much because individuals have changed, right? All the people who are known as Generation X, right? Can you imagine X stands for no more? You are out. And most of us, whoever is pre-1990s, right, is known as X, right? Because consumption patterns think that we are rich, we are income, but we are not spenders. Right? Even today, when I have to spend money, I think how I can save money. So let me tell you, we are X because we are the worst consumers that can be. High income, lowest consumption. And then our kids came in, born in 1990s till maybe 2005-10. So they are known as, almost simply put, a Generation Y, right? So they heard something from my mother who was telling me don't spend money, and something they were seeing in the market that money can be spent because they started earning. And suddenly last 10 years, 12 years, not one, but Generation Z is called. Generation Z is, I think Generation Z is Z1, Z2, Z3, because every 3-4 years, if you have a child who is 3, 4, 5 years younger than the elder one, they are two different classes, right? They don't know. They have not lived an era where savings were required because there was no income. There's no. Today they are talking about YOLO. You only live once. I did not know what YOLO was. I thought it's a song or something. Till I understood acronym is you only live once. I don't know how to live once, very frankly. Right? And my son, and then COVID came in, where everybody thought there's no tomorrow. Everybody became James Bond. Right? Everyone to die today. There's no, don't die tomorrow. So then where is the good news? The good news is, if you still want to earn and keep your wealth in, there's a product called, which won't invest in these consumption patterns. This is a very boring area, because this is value-based and growth-based. We will confuse always. This change is this because of the change in preference habit. Because thank God all the money is not with me today. It is with other people also, next generation. And digitization in India especially has changed many patterns. Like I would buy one shoe and make sure that we wear 3 for 5 years and have every excuse. Look, we knew every shop where I could mend my shoe. Today, if I have one scratch, the thing is go online, order the shoe. From where the shoe is coming, I don't know. Maybe Coimbatore, maybe Calcutta, maybe but delivered in Bombay. Because I'm going to look at some discount or something, but the best shoe. Right? So all the digitization patterns change. So you won't believe, from one shoe, generally my biggest crib of my wife against me is, I don't have space to keep your clothes. I don't have space to keep your shoes because they're lying all over. I don't have place to keep. And we are not throwing anything away. So even if I'm not spending, I'm still spending by impromptu, right? Because maybe I'm thinking, wear a sneaker. I'm thinking of buying multiple color shoes. I'm thinking of walking shoes. All this I could not afford. And what is happening in India? Per capita income has gone up. It's simply put, your consumption pattern has gone up. Your spending pattern has gone up. Nuclearization of families are happening. Today, wherever we are, we will go to 40% urbanization by 2030. Right? Nuclearization families are already happening, double income people, right? And what this is leading to is a boom which already happening with us, in front of us. Do not get swayed by conversations that, some companies think their growth is not happening. Because that company is getting challenged by another company, that is why. So one of the leaders in the chips, right? I'll not take the name of the company, you will understand, got challenged by an Indian company which was making chips locally in some state, or somewhere, and sending out India. So price and volume both came in. So, yes, that was Rajkot, Balaji, right? So these things will happen, but the consumption is no more the FMCG 20 years back. 20 years back, there were 15, 20 companies only. Do you know how many companies qualify consumption today? Close to 500. Because consumption is not FMCG, it is not only staples and durables, it is beyond that. It is your retail, it is your electronics, it is what you're spending in shops, it is your eateries, it is your cosmetics, it is aviation, it is telecom, it is healthcare, not pharma but healthcare, hospitals and diagnostic centers. It is going to reality. So today consumption is 9 segments, 9 industries total put together, 37% of Nifty 500 is consumption. 37%. And 31% of Nifty 50 is consumption. So only financials and digital literally are out, and oil and gas, but otherwise almost everything comes in that. And this is well diversified. So and the important thing was, when we were coining the product, we said, what should we and how should we manage the money? What the fund managers have come to a decision is this, that India is a blend of everything today, right? We cannot take a stand that we'll only invest in, compounders company. But so what we have decided is about 30-40%, and would like to say 30-50, because there can be a time when I would like to increase the allocation. Will be in stable, compounding, scalable, good managed cash flow companies. Almost equal, maybe 30-40% can go into high growth companies where valuation may be more, but growth will be justified. And 10-20%, depending on opportunity, we are keeping for new age companies, right? Because what is happening, while I may talk about TVS as a consumer, we'll talk about Hero, But they had to reinvent themselves in electronics because Ather or Ola Electric was coming in. So they are the disruptors, new age companies. So Swiggy and Zomato, I really don't know what I should call these companies, but these are ideas which are successful and they are in the consumption pattern. So we have decided that these ideas sometimes may not come in either in the compounding or maybe in the high growth because they are well settled company. But these are new ideas which needs to be looked at, should not completely abstain. It will be a mix of all three, stable, high growth, and their new age ideas companies. So that is like what emerging trends or what we call them. So that is how the portfolio is going to get built. And what we think is well diversified. This is going to be well diversified. 35-40% of the industry is going to be here. Of the total market cap is going to be here. So yes, bottom up ideas, top down, all those processes will be taken care of. But this growing trend of India is this, that if you think you're already rich, you're mistaken. So where I started, I'm coming back. If $2,700 per capita is enough, right, then it is a mindset because we are children where India was 420 years back. $500 per capita, India was 20 years back. We are 5-6 times up today. 22 years back, 65% of India was below poverty level. An exact number, about 70 crore Indians were below poverty. Today, population has gone from 105 to 140, 45. Below poverty is broken below 15%. World has never seen anywhere happening. 18% of the world population is living here. So if that 65% remained below poverty, today that number would have been 110 crore population. So what was the population 20 years back? Today, equal to that population would have been below poverty in India if macro growth, what we generally call GDP, would not happen. Again, macro growth restricted to cities. Remember when I talked about Tiger Zinda Hai, I mainly talked about Tamil Nadu, Gujarat, Maharashtra as states, major states, right? States like Punjab which developed long term. But in the last 10 years, anybody wants to guess which is the highest growing industrialization state of India? Okay. Not industrialized, it will become, I am telling you, but the answer is not UP. Nahi. Base, you Tamil Nadu, Gujarat already had a base. Nahi. It is MP. MP, huh? Surprise. But whoever said UP, the biggest change in per capita income in UP. When I say $2,700 per capita India, south of central India, Maharashtra, South India, is about $34,000. You are already that much. North, UP has just gone to $1,000, $1,100. Now imagine when UP is 2,000, they're not far, 16% of population of India, 20 crore, average out are going to be richer, right? No points for guessing. Major of your consumer companies are going to set up every shop in UP because the problem is this, that if income is going to increase, but where will more income go? And where will people spend more? Because when electrification of UP, MP, Jharkhand, Bihar happened last 10 years. Tamil Nadu, Punjab already electrified. So if electrification happened, infrastructure to buy electronic goods will start, and along with that, not only that, electrification will also means that I don't have microwave, let me make my life easy. I don't have television, let me make my life easy, right? Tamil Nadu, Punjab, all these places, Delhi, they would already have this electrified. They were buying 2 television, 3 television different, right? So trends will continue in India. Maybe states, it will be different. So $2,700 to $4,000 to $11,000 in the next 15 years is going to happen in India. So, when we talk about USA, habit preferences change, generations change, spending went up, and USA went one step ahead because they leveraged. They don't have high savings. India will continue to have savings. Now, if this is going to happen, both things are required. You are required to take care of savings, and let consumption happen, because remember, if consumption doesn't happen, growth will not happen. How will set up, from where will factories run, how will employment came up, it has to be balanced out. So 15, 20 years, good, both aspects. Even when I say this, our business is going to grow. So today I was talking to someone, we are less than $1 trillion business. Total mutual fund business in India is less than $1 trillion, 65 lakh crore. Right, 68 lakh crore. So should this not be like 10, 100 lakh crores, $12 trillion. And that will happen in next 10, 12, 15 years. So who will get this money? And converse also true, if you don't get it, money is still there, somebody will get it. Right? So do not lose hope. Because I started to ask you to gear up for the challenge, the medium long term does not change. Similarly, this is a year of consolidation. Take the most benefit of this. Challenging, psychologically very challenging. Your customer will challenge you even more in the conversation. So just remember and do what I just said. Do not forget what I just told you, and that will give you courage at that time. So you are most required today. So let me stop here and say and give you best of luck. Thank you for giving this opportunity on short notice.
Now I request Mr. Venkata Subramaniam to give a memento to Mr. J.P. Singh and Mr. Rohan.